With respect to targeting the right investors, this is really, really important. Money is not a commodity. Venture backing is not a commodity. You absolutely need to understand who your investors are and who they should be. So I'll give you a few rules of thumbs that I tell investors, entrepreneurs all the time. The first is size. And I think that somebody mentioned earlier in the morning that uncommitted capital is important. And that is true. But you also have to make sure that you are appropriate for the portfolio being constructed by the fund in question. You want to be meaningful to it so that you get their time and attention and they take your business seriously. But you want to be small enough that you have room to grow and that they can invest additional capital. Rough rule of thumb is fully financed, depending upon whether you have one or two venture backers. You'd like to be somewhere in the 7 to 10% range in the life cycle of your company. So if you are raising $20 million, you expect to have two venture firms participate. And this is over a series. Maybe you're raising $4 million now, and if you're successful, 8, and then you're going to ultimately raise another 8. That $20 million, if you're going to have two venture backers, take it in half, $10 million per venture backer. You really like to not be in a fund that's much greater than a couple $100 million. You are just not going to get their attention. You're going to end up being a rounding error. And we actually are investing in a company now that received almost $10 million from a very well-known large venture capital firm and was gaining a lot of traction, making a lot of progress, and ultimately that venture firm, that VC firm, just said, you know, this is too small. We're going to retrench, especially in the current environment. We're not focused on you anymore. No more money can come forward. And this company was making tremendous progress. It had gone from like 6 clients to 24 clients in 12 months and was cash flow break even. Could not get another dollar because it was just not meaningful to that venture backer. And they said, look, your cash flow break even. Hopefully you'll make us some money, but if you don't, who cares? We got bigger opportunities to grow. In terms of a start, you also want to be not a fly on the wall. You want to be somewhere in the 2 to 5% of that partnership's total committed assets. And just to get their attention, you don't want to be a 0.5% of the fund going in. If you're raising $5 million against a $1 billion fund, trust me, you're not going to get their time, energy, and attention. And when the rubber meets the road, as it often does for young companies, you will be left on the sideline. Second thing is that you want to make sure you get value-added roles from your venture backers if you can. And there are 4 or 5 areas that I can say, at least at a board and governance level, are really important to have amongst your board of directors. A lot of these will not be able to be fulfilled by venture firms. That's not exactly their areas of expertise, but certainly if you can get it from them, it'd be great. You want obviously some operating expertise, somebody who's been there, done it before. You want somebody who has domain expertise, industry expertise in the area that you're targeting. You'd like to have financial expertise, and most of the times you can get that from your venture investors. You'd like to have some strategic expertise as you think about partnering with other companies, acquiring other companies, ultimately being sold, or doing some other form of a joint venture. That can often be gained from your venture backer. And finally, you'd like to have some company building expertise. And the people who have been in this business longer than we have a fair degree of that. So you'd like to fulfill all those things. Normally, the domain and operational, you will have to seek elsewhere from other, as Meg said this morning, sitting CEOs or people in your space who are recently retired who can be helpful to you. The third thing in terms of the right investors is you want it to be a core strength of the VC firm. Don't ask people to stretch too far. If people invest in enterprise software, don't approach them with a nursing center as a potential investment. It just doesn't fit. It's outside of the area of expertise. You may be the most dynamic CEO, and they may ultimately decide, yeah, they really want to do this, and they're going to stretch. It is always a mistake. Knowing the business you're in, trying to stick to your knitting, as venture investors trying to stick to theirs, is very, very helpful, and you will get the most from it. They will know where the bodies are buried. They will know the strategic landscape. They will know where people are that you can recruit, and they will actually have been there and done it before, hopefully. The last thing is right stage. There are people who invest early. There are people who invest in the middle, in the growth phase, and there are people who invest in the later stages. And you really want to make sure that you're aligned with respect to what the VC firm is best in.